Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. I have hit, if you cannot tell, the open road. I'm joining you today from scenic and rustic New Hampshire. We're not going to have the usual production stuff that goes on because I don't really have any producers. But there were some things that I thought would be interesting to talk about. First of all, I apologize for not doing the live stream on Monday. I was traveling across the country. I think on Monday I was in Park City. So now I'm in New Hampshire. Tomorrow, June 13th, shareholders are going to be voting in Tesla's shareholder meeting. And this was the thing that I really wanted to discuss today because this has gotten a lot of play. I wrote an article about this. I'm going to be working off of that article. If you're interested in looking at the article yourself, you may go to deltagroupadvisors.com. So that's Delta Group Advisors, ADVISORS, all one word. Scroll down and you will see this article published there entitled An Options Trader's Case for Elon Musk's Pay Deal. I called the article that because Stephen Wilmot, who is the columnist for Heard on the Street for the Wall Street Journal, also an editor there, wrote an article entitled The Case Against Elon Musk's Pay Deal, which was published last Wednesday, June 5th. So I wrote this article last week, and basically I was addressing some of the points that Stephen Wilmot brought up, and I addressed some other points too. Now, the reason this is an important topic, I think, for us today, a couple of things about it. One, of course, is what are the implications for Tesla, depending on how the vote comes out tomorrow, which I think is important. Another thing is that I actually think that the Delaware Court of Chancery, so that is the court in Delaware, which is where Tesla is incorporated, that rescinded the pay deal in January of this year. So let's provide a little bit of history first. In January of 2018, the board of directors of Tesla submitted for a shareholder vote Elon Musk's compensation plan at the time. And the compensation plan was almost entirely options. In fact, it was entirely options. Options that are slightly different than the ones that we normally talk about here, but I'm going to highlight some of those differences. These bespoke options are sometimes traded, or not traded, but are created in other contexts. So let's go over what that was at a high level at first. So rather than receiving any cash compensation at all, Elon was going to receive, and actually indeed did receive, before it was rescinded, a compensation plan that was going to provide him with 12 tranches of options. Now, options issued by a company are different than the options that we traditionally trade or invest in the secondary markets day to day. Why is that? Because when a company issues an option, bear in mind that where I am, one of the reasons that I traveled across the country, so a little bit of backstory here, was because we go to the East Coast this time of year commonly, and usually we don't bring our dog when we come. But my wife desperately wanted to have the dog. We looked into various options to fly the dog. None were that appealing. She didn't want to put her in a crate, so there's this new, I think it's called Bark Airlines. We contemplated doing that and flying into Westchester. There are other arrangements you can make. All of those options are extremely expensive, but to bring the dog, we contemplated it. But one thing led to another. Everyone else is going to fly out. I ended up driving, and I brought the dog. Okay, so that's the story. So that dog and two others that are here may show up. That's just how casual this live stream is going to be. Okay, when a company issues options, the critical difference between that and conventional secondary markets options issuance is that if you buy a call option in the secondary market, your immediate counterparty is the OCC, the Options Clearing Corporation. And the counterparty for every single person who enters into a listed options trade, for those options that trade on the listed exchanges in the United States, The counterparty is the OCC. That guarantee, that provides a level of insurance. It's a simplifying thing. It's the central clearing mechanism. When a company issues options, and this is important to understand because it has implications for the value of businesses that offer options-based compensation, including Tesla. If options are granted by a company to their employees, when those companies exercise their options, they are not exercising against the OCC, which in turn will do whatever it needs to the other open interest. It's just against the company itself. So if a company issues a call option, then if the employee exercises that option, they actually have to pay the company for the shares that they are purchasing at the agreed upon strike price. So in the case of the 2018 compensation deal with Elon Musk, and I'm going to make some simplifying statements here. If you like, all of this information is publicly available. I believe I created some links in that article, the Delta Group Advisors article, which you can go to, which include, among other things, the submission of the pay plan to the SEC. What you will then be able to do is get more details. But I'm going to make some simplifying assumptions. The company valuation at the end of 2017, the market capitalization of Tesla was, and I'm also going by memory here, don't have any notes or prompters. I have a screen over here, which I'm going to allude to the article. At the end, on December 31st, well, actually the last trading day of 2017, the market capitalization of Tesla was about $57 billion. I'm going to use $60 billion just so that as we work through this, the math will be simple. So the pay deal offered 12 tranches of options struck, so the exercise price was at the prevailing market price. So that would normally seem like a call option. These had 10-year maturity, 10-year tenor. But these options were unlike the ones that we typically trade on exchanges. How so? They had what in the pay plan was referred to as milestones. Now, I hope people will sort of try to delve into this because the Delaware Court of Chancery ruling, I think, was not only in error with respect to Tesla, but it set some really, really bad precedents. And hopefully we're going to get into that. If the employee exercises the option and they buy the stock, they're buying it from the company. So they actually have to pay the company for the shares. So if we assume that Tesla was worth $60 billion at the time he was granted his pay deal, every tranche, every one of the 12 tranches entitled Elon Musk to purchase 1% of the company at its value at the time the options were granted, but they still had to vest. Now, this is another interesting thing. So in order for the options to vest, he had to hit these milestones. And those milestones were both related to the increase in the value of Tesla. We'll call it the market capitalization. So the share price, in essence, which is a common target that is offered to executive teams at publicly traded companies. An important objective for management is to improve the value for shareholders. The value for shareholders is the actual value of the company, the value of the shares. So that obviously creates some alignment between the corporate management of a publicly traded company and the shareholders. Importantly, in addition to some extraordinary milestones, so those milestones included increasing the value of the company by 50 billion, 100 billion, 150 billion, 200 billion, and so on. So every single tranche, the objective was that the value of Tesla had to increase by $50 billion. So maybe we'll just call the company worth about $50 billion. And so if you double the value of the company, that would permit you to, that was one of two milestones you had to hit for the first tranche of options to vest. The other was an operational milestone. So he had operational milestones related to the increase of the value of the company, milestones involving the increase in revenues, and milestones involving the increase of earnings. And in the context of his pay package, they were measuring earnings as EBITDA. EBITDA is earnings before interest, taxes, depreciation, and amortization. Whether this is a good measurement or a bad measurement for the operating performance of a company is a separate question. If you ask Charlie Munger, he would say, anytime you see the word EBITDA, substitute BS, but I actually don't subscribe to that idea. But I will point out that it is very important to understand the depreciation, amortization, and CapEx for a company in particular to understand how earnings are actually improving. But earnings before interest and taxes certainly is a very good metric. So the milestones involved 12 tranches of the value of the company, and 16 milestones involved with the improvement of the operating performance of the company. 8 of those were related to revenues. The top of the 8 milestones associated with revenues involved multiplying revenues by about 15-fold, believe it or not. And in the case of EBITDA, which I believe, and again, I'm going by memory, at the end of 2017 was about 167.8 million US. The top milestone on the EBITDA side involved increasing EBITDA by more than 80 times. So contemplate that for a second, that the pay package milestones involved doubling, tripling, quadrupling, quintupling, sextupling, septupling, octupling, whatever nine-tupling is, 10 times, all the way up, $50 billion each time, 15 times revenues, more than 80 times EBITDA. If he achieved a market capitalization milestone, so let's say he doubled the value of the company, and he also accomplished one of the operating objectives, he had to do both. In order to do that, then one tranche would vest. So you had to get 2 milestones to get one tranche to invest. So the lowest performance he could deliver in order to have just one tranche invest was essentially a near doubling of the value of the company and a huge increase in either EBITDA or revenues. Granted, these two are related. If the revenues increased, probably the EBITDA would too, and so on. If he accomplished that with each tranche, he would be entitled to buy 1% of the company at the value that the company was when the grant was provided. He would receive no other compensation. If he increased the value of the company by 30%, he'd make nothing. Increase it by 40%, he'd make nothing. So this is an extraordinary set of milestones. So these milestones have implications, important implications for how you value an option. So the options that we talk about, that I talk about with you all usually, are what we call vanilla or plain vanilla options, the calls and puts that are commonly traded on exchanges. These exchanges have standardized features, the expiration date, the strike, whether it's call or a put, obviously, things like that. Those are all standardized. There are some minor distinctions that can happen in exchange-traded options. Are they European options? A European option can only be exercised on the expiration date, or are they American-style options? Those can only be exercised at any time up to and including the expiration date. In the case of his options, the American or European thing wasn't what was unique. He could exercise these options effectively at any time once they had vested, although they would vest into restricted shares. So he could not then buy the shares and just blow them out, which is important. But these milestones are something that conventional options don't possess. If you buy a call option or if you buy a put option, you don't need to go out and do some other trick for that option to actually come into existence. The type of option that we're talking about here, when we talk about OTC options, is something called a barrier option. And this in this case, it's also a knock-in. So in this case, the milestones, we'll think of those as barriers. And when the stock value increases by enough, and if he increased the operating performance by enough, then the option would actually vest and he'd be able to do something with it. So when we think about this, you begin to recognize that reduces the value of the options in question. So I actually did some calculations based on the volatility of Tesla at the time and calculated what the value of all of these barrier options were. And I also started to think a little bit about how difficult some of these things would be to achieve. And so I can actually share some of this with you. So you're not going to be able to see me, but I'm going to actually share my screen. And by the way, I'll be able to take some questions and we'll fool around with options play hopefully a little bit. But let's take a look at this. So this is, I had some tables in here from this article, so forgive this this technique that I'm going to be using to show you these things. But I have a mechanism here. Let's see if I can find that table. Um, there we are. Okay. So these are the tranches of options, how much the stock had to increase, and the market capitalization. So if you look at the second column, that would be the market capitalization of Tesla. So the first one was 100 billion. That was a $50 billion increase. So again, just we'll simplify it and call the company a $50 billion company if he doubled it and he met some other accomplishment. So what was the value of that option ignoring this barrier, this knock-in? So that option grant was about 366 million, and all of these higher. So you can think about the market capitalization increases as ever, well, I mean, not higher strikes per se, but higher values for the company. Now, the important thing here is that we have to think about the likelihood that he would accomplish these objectives. And so I took a look at all of the companies in the Russell 1000 between January of 2018, at the time of the grant, and January of 2024 to see how many companies actually had successfully, and I'm going to keep this on the screen for just a second. So this is kind of a rough way to think about it. So if you can screen grab it or whatever, or you can actually just go to the article afterwards if you like. And what I learned was that, and this should surprise nobody watching, very few publicly traded companies had performance that even came close to this. So first of all, increasing that much in value, we know that there were very few companies that increased that much in value. Apple did, but it was not as much of a percentage change. But in terms of the absolute increase in value, it became a multi-trillion-dollar company. When we take a look at all of those milestones, though, operational, so that means increasing the revenues by roughly 15 times, increasing the earnings by 80-fold. There was actually only one other company that managed to accomplish both of those things and also managed to increase on a relative basis the value of the company by that much. The only other company that did this was AMD, and AMD was about a $230 billion company by January of 2024. The likelihood of accomplishing that, therefore, was exceptionally low. So you have to discount the value of those options to compensate for that, for the likelihood of all of these barriers being hit. And we can model these things, and I did. It turns out that this works out to contemporaneously. So contemporaneously, meaning if you go back in time and you say, well, how much was the value of an option grant like this at the time that it was granted? And it turns out that that works out to, by my work, about $1.3 billion in total. Bear in mind that at the time, Tesla issued this grant, Elon owned about just under 22% of the company, 21.9% of the company. So if you think about the remaining shareholders, the remaining 80% or so, what they were going to be paying Elon was effectively $100 million a year, a little more than $100 million a year. That was the value of the option grant for 10 years. Now, that's very high pay for a publicly traded CEO, but it's not the highest. And of course, now with the benefit of hindsight, we learned that indeed he was one of the best CEOs around. So while people like to say now, well, look, the value of these options are 30, 40, $50 billion. I think Stephen Wilmot wrote that it was a $46 billion pay package. Well, that's what it's worth now. But think about this. Had you gone back in time and said, okay, well, we're going to give you $100 million, then he could spend that $100 million however he wanted. He could have purchased options on Tesla in theory. You can't actually, because he's the publicly traded, he's the CEO of the company. So that you can't really affect those kinds of transactions in the secondary market. But, perhaps he could have bought call options in NVIDIA. That would have obviously paid off very well. So understanding the value of those options with the benefit of hindsight is not a good way to think about this problem. So I would say, to begin with, the compensation deal was an extraordinary one for shareholders in the sense that it didn't require them to have any cash outlay. And folks who followed Tesla for some length of time will remember that the company did, from time to time, have cash flow related issues, and that wasn't applicable here. So what happened in January of 2024 when the Delaware Court of Chancery decided that they were going to rescind this? So what we had was a shareholder with some plaintiffs' attorneys who decided to sue in the Delaware Court of Chancery, and the pay package was rescinded. And some of the reasoning that was provided, and you can go to the court decision, this is 200 pages, so you probably don't want to read it. If you are looking for a summary of it, the American Bar Association wrote, a guy wrote a summary there, which I think is kind of helpful. But I think there's some very important things in here because it has implications for the granting of options-based compensation for all publicly traded companies and how we think about what is fair, what is just, and so on. So the first thing was that part of the reasoning that they provided when this decision came down was that the need to give him an option grant like this was unnecessary for purposes of employee retention and compensation. So the Court of Chancery suggested, or what the case was made, that they didn't need to give him a big options-based incentive plan to retain him as the CEO. Okay. That may be. He proposed the pay plan, and that comes up in a little bit. Did they need to give him this much incentive-based compensation to retain him? One of the reasons that they stated that it was not necessary, this is, and I hope you can follow the logic of this one a little bit because it's really an extraordinary extraordinary concept. They suggest that the reason you didn't need to provide him with incentive-based compensation was that by virtue of the fact that he already owned more than 20% of the company, he had a big incentive for the company to succeed regardless. And arguably, that was also an incentive to retain him as CEO. The logic being that if all of your net worth, and you are the largest shareholder of a company, is tied up in it, that assuming you think you are the most capable person for the job, you'll be reluctant to relinquish the helm to somebody else. Now, on its face, that may seem reasonable for a moment because, of course, it's true. Every shareholder has a meaningful interest in seeing that the company succeeds, in seeing that the company's share price goes up, in seeing that the company's revenues increase, in seeing that the company's free cash flow and earnings rise. But that doesn't serve as compensation. And it doesn't serve as compensation because they already own it. And the example I provided, but one way to think about it is if you have a company, you create a company and you're the general partner, you own 20% of it, but you need capital. So you go out and you get limited partners and they provide the remainder of the capital, 80% of it. And you operate this company for 10 years and you do a good job of it, a really good job. And now it's time for your compensation for the subsequent 10 years to come up. And so you go to the limited partners and you say, I would like the right to buy 1% of the company at its current value if I can double it, triple it, quadruple it, and so on. Which, by the way, is a pretty good deal because for the limited partners, think what they get if you accomplish these incredible objectives. And they are quite incredible. As we've pointed out, there was only one company out of 1,000 over the period of time that managed to accomplish this. That was Tesla. And they said, no, we're not going to pay you any compensation. We're not going to give you options. We're not going to give you anything because you're already tied to this. I mean, you own 20% of it. So we're not going to pay you anything. What are you going to do? You're going to run off? This is an extraordinary logical flaw because one can imagine that if by that logic, you don't need to pay your executives, well, executives never have any interest to own the business because if they buy into it, if they buy the shares, if they already own some of the company, they have no incentive to continue to work for it because the remaining shareholders are going to say, you're tied to this anyway. So we're just going to sit back and not pay you anything. Maybe some will continue out of their own desire to preserve what assets they have to do something. But that's obviously a real problem. This would never fly in any other context. But by virtue of the fact that the options did become valuable because of his actions, I think, and also just because people don't work their way through that problem. They don't see the flaw in it. They think, well, you already own some of it, so that's good enough. That, to me, is an astonishing conclusion. The remainder of those shareholders then, where he was going to get tens of billions, they actually got hundreds of billions of dollars in increased value. And they have decided that they're not going to pay him for that. Not going to pay him because, he already owns some of the company. That's a pretty flawed situation, and I hope I've spelled this out in a way that makes sense so we can see what's wrong with that. Another real area of issue, and I appreciate you guys bearing with me for this before we get to the other questions. And the reason I bring this up, maybe some of you are shareholders. The shareholder votes tomorrow. Maybe you care about these kinds of things in the context of other publicly traded companies. Another reasoning was independent investors. There was a suggestion that the investors of Tesla were not wholly and truly independent. Couple things that they used as evidence of this. The first was that many of the directors had previous and lucrative relationships with Elon Musk in the past. They had done other business deals with him. Maybe they were involved with PayPal or other things that he was involved in. And many of them had benefited financially from those relationships. So the suggestion was that they were therefore independent. Now, what's interesting is that's the suggestion, that's the reasoning, that's the logic. But there was never any suggestion that there was either an ex ante or ex post facto quid pro quo, meaning that there was his previous business relationships. The directors didn't have any incentive to simply reward him with a good pay package now that had incredible milestones, simply because they had had previous experience with him that was good. And nor was there any promise that he was going to give them some form of a reward other than their interest in Tesla, which, by the way, would increase many times if he hit these rather incredible milestones. And then there's another final point I would make, which is who better to judge how much a superstar chief executive is worth to a company like Tesla, which is the first company that has built electric vehicles at scale profitably. Now think about that for a second. Lucid hasn't done it. Rivian hasn't done it. The legacy automakers haven't done it. Ford sells electric vehicles, but not in the same scale, and they don't do so profitably. General Motors, same thing. General Motors had tried to sell electric vehicles in the past. The only company that's building electric vehicles at scale that we believe is profitable is Beyond Your Dreams, BYD, the Chinese company, which obviously has many different advantages, one of which is that they were a battery company to begin with, and they manufacture in China, and there are advantages to being a Chinese manufacturer. Okay. In 1984, Nike decided to spend all of its marketing budget on one player, one rookie player. And that player was Michael Jordan. And a movie has been done about this, and you can't stop me if you know this one because this is a live stream, and please put into the chat whether you've seen the movie about it. But what was extraordinary about that was not just the fact that they were going to pay him $500,000 a year, which was extraordinary at the time. Bear in mind that I think Larry Bird's total compensation for 1983 was $1.8 million. 650,000 or so was in salary, and the rest was endorsements. Endorsements plural for multiple companies. I think Magic was the top paid player at the time. What the Nike executives knew, Vaccaro and Phil Knight, was that Michael Jordan was a unique player, and he deserved a unique compensation plan. He was a true superstar. They also gave him milestones. Be named to an All-Star or an All-NBA team. I think he had to average more than 20 points a game. He had to be named Rookie of the Year. So basically he had to live up to all of the promise of the superstar billing that he'd been granted before this happened. But what was truly unique about his pay package was that unlike shoe deals prior to that, he was offered a revenue share. And that was just not something that was done, really, until that time. And that compensation, that unique arrangement, made him a billionaire. He, just from the Nike deal alone, got $1.3 billion for the Air Jordan line of products. Unheard of at the time. But Nike shareholders won on this arrangement because the value of Nike increased by, up to about $50 billion bucks. So he got over $1 billion for the revenue share, and Nike's value increased. Tesla, to grant a superstar CEO, it's kind of similar situation. So the board of directors that had previously worked with Elon Musk obviously knew a little bit about the guy. They knew what they were dealing with. They knew why it was a good deal for them to have him as CEO. There's something else, which is the concept of adverse negotiation. Adverse negotiation occurs when we negotiate, or two parties are negotiating, and they have contrary interests. A good example, and the one that I provide in my article, is you go to the car dealer, you want to buy a car. For every dollar you manage to haggle the price down, that's an extra dollar in your pocket, and it's a dollar less in the pocket of the dealer. It's a zero-sum game, and that's a perfect example of an adverse negotiation. If a CEO is negotiating over cash compensation, you have an adverse negotiation because every increase in the CEO's pay, dollar for dollar, is a decrease in how much cash the shareholders get. The interesting thing, though, is that that isn't entirely true when you start talking about incentive-based compensation. A couple reasons for this. Shareholders prefer incentive-based compensation. They would much rather pay a CEO for hitting ludicrous benchmarks and milestones along the way than to pay them $100 million in cash. The other thing is that if you're paying them in cash, that's a cash expense that reduces your free cash flow, your EBITDA, et cetera. So whatever multiple the company is worth. So you're going to get a higher multiple basically because you have an incentive-based compensation, you have more cash. All of these things actually add value. The fact that the directors weren't negotiating hard against Elon for making a potentially very lucrative proposal for himself that is also very much in the alignment of shareholders and probably very low probability. I think the highest tier, I calculated that at best there was maybe a 2% chance that he would hit these things. So that was also flawed. So the court was completely offsides with both of these. The court also questioned whether the milestones were ambitious. I already got to this a little bit. Multiplying revenues over 10 years by 15 times, multiplying EBITDA by 80 times, multiplying the value of the company by 10 times or more. If you don't think that those things are ambitious, well, you probably don't work in the investment business. That's the first comment I would make, because they are clearly very ambitious. But what they suggested was that, well, they had already set the roadmap in place. Tesla had created a roadmap. They had a business plan, and if they executed on that plan, then all of these things would naturally fall into place, which is pretty comical when you consider that publicly traded companies in a competitive industry are up against other sharp minds and other very sharp-elbowed individuals. It is not simply good enough to come up with a plan. Everybody's got a plan. As Mike Tyson said before he fought Evander Holyfield, everybody's got a plan until they get punched in the mouth. But even if you do have a plan and you try to execute on that plan, that doesn't necessarily mean you'll be successful. And very few are. We know, for example, another example I use here was, professional golfers. You try to play a conservative, but a mixture of a conservative and an aggressive game. You don't want to expose yourself to bogeys and double bogeys, but you hope you set yourself up when the opportunity arises for birdies and better, maybe. And consider the U.S. Open in 2000, Pebble Beach. everybody probably had that exact same plan. This is the best golfers in the world. By the weekend, only 70 of them are actually playing. And by Sunday, only one player, one out of the entire field was under par. Tiger Woods, he finished 12 under, and the next best player was 3 over, which means that he basically lapped the field by almost a stroke, a stroke aside each day. 15 strokes, so almost a stroke aside against the best players in the world. So it's fine to have a plan. Everybody's got a plan, but executing on that plan is a very different thing. So I feel like the court really fell down on all of these things. And the reason I bring all of this up is because it also sets a horrific precedent if what we do is every publicly traded company executive believes that if they get a highly incentive-based plan, that if in fact they execute on something extraordinary, and this is extraordinary, that they're just going to pull it back. What incentive would you ever have to go along with this? If I manage to multiply the value of the company by 10 and all the rest of it, and you make a deal with me that you could buy a portion of the company, because he still had to buy the company at the value of the business at the time the grant took place, they would never have any incentive to do this. So I went into this simply because I think it's important. And it's particularly important to me because there was a history of malfeasance and misdeeds in executive options-based compensation plans a couple decades ago. And some of you watching may remember that what was called the options backdating scandal. What happened was companies were granting options to their executives, and then after the fact, they would set the strikes. So that's why it was called backdating. They would say, oh, you're going to get options on however much of the stock. And then they would go forward in time. And then with the benefit of hindsight, they would go back and pick the lowest stock price that had happened in the preceding period and select that as the exercise price, as the strike price. That is stealing from shareholders. And those people effectively got a slap on the wrist. And they also said, well, you can't do this anymore. So out and out stealing. Absolutely immoral and unethical, should have been illegal. Those people should have been thrown in jail. Horrible, sinister stuff. This is not an example of that. So anyway, if any of you are Tesla shareholders and you have not already cast your ballots, or if you did and this changed your mind and you can do something about it, I really encourage you to consider voting for this pay package because it is writing, as in correcting, not as in writing a call option, what I view to be a pretty serious injustice. Now, I normally like to put the questions up on the screen, but because it's just me doing this and I barely know what I'm doing, let me see what I can help you do with. Okay, so can I scroll down on these questions? Let me see here. So the first question from MM says, I think the Delaware ruling from January was just a normal person, chancellor, bug-eyed at the aggregate money amount and balking. So emotional response. Could be. Quite possible. It's not about the scales of justice, though. I mean, it's extraordinary. It's, some form of political activism from the bench. It's politics of envy kind of stuff. I have no axe in this, right? I don't benefit one way or the other, except that I think it's a really bad precedent, and I think we'll pay a price if this kind of thing goes on. So next question is unrelated. Mike, what strike delta would you use in selecting a crowd strike covered call? Shares are owned. Thank you. That is from Joseph Kamen. Hope I pronounced that correctly. So let me flip over here. We're going to take a look at option display, and you'll listen but not be able to see me, but we'll see something that looks a lot better, which is option display. Let's take a look at it. Okay, so a couple quick points with this. Remember, when we talk about covered calls, a couple of things that I like to think about. One is the probability of assignment. So what is the likelihood that an option actually ends up in the money? That doesn't mean profitable, because you can sell a covered call for, let's say, $3 and it can end up $2 in the money. So you could potentially be assigned or have to buy it back and pay the intrinsic value to recover that option and then roll it out or whatever. But that doesn't mean it's not profitable. That would potentially be. And actually, even when you sell a covered call, if it's in the money, overall your position is profitable. Maybe not as profitable as it would have been had you not written the covered call. But it does mean that the stock most likely has, unless you were writing in the money calls, which you should not do. Oops, sorry, I'm hitting the wrong button. So let's just take a look here. So you own the shares. What covered call? I'm just going to use the midpoint here. What call do you want to sell? Okay, a couple quick things. You'll probably observe that I don't have my Bloomberg. So for those of you who are familiar with Bloomberg, you have to have a serial number installed. This isn't the computer I'm sharing the screen of here isn't even my own. So obviously I don't have a serial number for that installed. This is my nephew's gaming laptop, for those who are probably not at all interested. So a couple quick things. I like to keep the options relatively short. I prefer not to write through what I believe to be meaningful events. Meaningful events are probably always going to include earnings, but can occasionally involve other things, like, for example, Tesla shareholder meeting. So one way to think about the of assignment is to look at the delta. And if we're looking over here in CrowdStrike's case, these are the deltas. Generally speaking, I think it's not a bad idea to try to keep that delta below 30. Below 30. So that gives you usually, in most cases, enough capital appreciation. CrowdStrike traded today, closed at 387 and change. You sell the 420s against it, you have about almost $33 worth of upside remaining, which is pretty meaningful. This is going out to July, which probably, by the way, is too far out in time. So why don't we just pick something a little bit closer? I'll use July regular way expiration, and you can be flexible about something like this. And there's something else, which is that I also am looking, and this is so let me just make this point. This is a basic generalization, but every company will differ. So I will often make the comment that I would like to see on options writing strategies that you are collecting at least 1% a month. How did I come up with that? Because it's a fairly specific number, but in the real world, companies differ a lot. Why did I come up with that generalized idea? The idea is that if you own stock and you are selling covered calls against it, you are still taking equity risk because you own the stock. Stock could go to zero. So I'm taking an equity-like risk. You deserve to have an equity-like return. Now, you can combine some incremental premium against it, and you can also combine the amount of capital appreciation that the shares could potentially offer you. In this case, it's from 387 up to 420. So, you're talking about round numbers, better than 8% capital appreciation. And you're also collecting $6.73. That's at the midpoint, which is not quite 2%, but it's well over 1% of the current stock price. So your total profit potential, in this case, over the course of 37 days, is handsome, right? It's 9% plus, and you're collecting well over 1%. So that's a generous yield. But the idea is that if you're taking an equity-like risk, you want to get an equity-like return, and that's where I came up with that 1% minimum. But companies like CrowdStrike are going to tend to be much more volatile than companies like Kroger, the grocer, or Procter and Gamble. So, when you think about these generalizations that I make, try to apply them with what you know about the difference between these companies. Highly volatile companies, the amount of premium you collect, and the amount of upside potential that you should incorporate is going to be necessarily greater. If somebody said, I can collect over any 30-day period, I can increase my income on Procter & Gamble or Kroger by 1% every 2 months, that might not be a bad deal because you're already collecting a dividend. The stock is not volatile. Their operating results are not volatile. So, you have to make those slight adjustments. But one way you're making that adjustment automatically, assuming that the options markets are reasonably efficient at estimating the forward volatility for the underlying asset, is to take a look at the delta. So 30 delta or lower, whatever you're choosing. But one quick point, and if we just pull this up here, if there is an issue when you're using an app like Options Play, but you can check this yourself, the other thing you want to make sure is that there was no catalyst. Here we can see works fine. This is the stock's trending in the right direction. The market trend is positive. In this case, the Options Play score is decent. But here's the important one. The earnings date does not fall within now and the expiration date here that I've chosen. That's not surprising because most publicly traded companies have, oh, whoops, I'm not sharing that. Here, sorry. So yeah, just double check these types of things. Stock trend, market trend, that kind of stuff. Doesn't necessarily have to be this application, could be any application, but just give it some thought. Okay, next question. My apologies. Let's get over here. Okay. Are you still holding the Jan 25 expiration SPY puts? Okay. This is also from Joseph Kamen. So just a quick point of clarification. I have often spoken about, usually when I talk about the hedging, and I use SPY as an example, it's because I know most people prefer to use SPY. Personally, I typically use SPX, SPX index options. Not a huge distinction between, by the way, between SPX options and SPY options. They both have the same essentially underlying index, which is the S&P 500. IVV is another S&P 500 ETF. You could use Qs rather than use NDX options. You could use IWM rather than using Russell 2000 index options. Why do I use SPX options instead of SPY? A couple of reasons. One of those reasons is that SPX options are European. And the other is that they settle to cash. And those two things are related. And it just gives me one less thing to think about. It will settle to its cash value. I don't need to worry about exercise or assignment and ending up in the underlying shares. This is not a huge problem for most people, by the way. I want to make sure that everybody understands. I'm not trying to dissuade the use of IWM or Diamond or Q or SPY options. These are great products. But I'm going to share a quick story and just give you some history. Many years ago, when I think this is Cantor Fitzgerald days, and we were executing a huge trade in IWM options. And if memory serves, it was IWM 84 strike options, short dated, teeny options, coming out of the credit crisis, so the market's whipping around. And I think we were buying 50,000 of those, and it was not for me. This was agency. So I was running a trading book, but we had somebody on the desk who was a sales trader. So at firms like most investment banks, you have principal trading, which is when you're trading the bank's capital, usually as a market maker, taking the other side of the customer's trades to help facilitate the trade. But sometimes you execute on an agency basis. A hedge fund calls you up and says, I want to buy IWM weekly 84 strike calls. I want to buy 50,000 of them. So we had a situation like that. And the customer and 50,000 is a decent chunk of options. And it was a volatile market, so it wasn't that easy to execute. We were laying off some of the risk, so I may have sold a few of them myself Then we were trying to find other market makers to fill in the balance. We executed a bunch against the street. So some were bought electronically and some were printed, where the market makers, of which I was one, sold some. The customer in question had multiple prime brokerage. There was a hedge fund, so that meant that they cleared some of their business at JP Morgan. They cleared some of it at Goldman Sachs. And they cleared some of it at, well, I'm not going to mention it because it was a huge thing, as you'll soon learn. Anybody who's familiar with the good, bad, and ugly on the prime brokerage side is probably going to be able to guess who the bank that I won't mention is. They had another clearing relationship with another bank, a European bank. And all of the facilitated business ended up at JP Morgan and Goldman, and all of the electronic executions, fills, ended up at this European bank clearing account. No problem. Trades are all up. All is good. A couple of weeks later, I overhear an assistant on the desk talking on the phone saying, "How can I take those back? Didn't those expire already?" And I was thinking to myself, what is going on here? So I waved to the assistant. I said, whoever you're talking to, stop. Put me on the phone. Let me find out what's going on. So it turns out that 6,800 of these 84 strike calls in IWM had been sent to this other bank on the trade date, and they didn't know what account it was supposed to go to. Now, the rules, OCC, the trading rules for the exchanges and the OCC, is that these things are supposed to clear and settle T+1. This is important actually because nowadays stock has to clear and settle T+1. So it used to be T+3, then 2, now it's T+1. It's creating huge headaches. But in the options world, we've dealt with T+1 settlement for a long time. And so eventually they figured out where those calls were supposed to go. And they were bought for a tiny amount. I want to say 7 cents a contract. So it's a tiny amount of money. 6,800 contracts, 7 cents or $7 a contract. It was a little over $40,000 in premium. It was not a huge trade. But here's the problem. The week that those options expired, IWM shot above 84. And those of you who are following this know what happens. If options are in the money at expiration, it's a courtesy feature that we refer to it as automatic exercise. Really what it is essentially where the brokers and the exchanges and the OCC have just decided that as a feature for the benefit of investors, that if they're in the money, they're going to be exercised by more than a penny or more, they're going to be exercised automatically. So 40 some odd $1,000 worth of premium converted into 680,000 shares of IWM at $84 at the strike price. Now, those of you who are following along, you probably know where this is going. So this bank didn't know where these shares were supposed to go. They lost the plot somewhere. And so they were just sitting on 680,000 shares of IWM. Early the next week, IWM rallied further. I think at one point, it went up another $7-8 or so. So do a little bit of math. We'll round it and say 700,000 shares, $8, $5.6 million. So the bank at this point is hugely profitable. They still don't figure out where the stuff is supposed to go. And then IWM starts falling. And it falls, and it falls. Still don't know. Finally, 10 days later, they figure out who the hedge fund customer was. And they push it to the hedge fund customer. And what do you think the hedge fund customer said? I'm not taking that. This was supposed to settle T+1. And what had been a hugely profitable trade at one point was now down about $7 million. And it was at that point that someone on the clearing side at that European bank called us and said, "Hey, will you guys take them back? Can you just take our $7 million loss for us?" If you're guessing what the answer is no, we don't do that. But ever since that time, I have been more sensitive to trading options that settle to the underlying asset, because if it had just settled to cash, you win. You get the money. That's it. and the rest of it all goes away. In every other way, SPX, NDX, the Russell options, and so on behave just like SPY options, diamonds, IWM, whatever, but it doesn't settle to the underlying. And you also don't have early exercise. And for me, that's a valuable feature. And it's particularly important when I'm trading something like a hedge, because the hedge isn't something I'm thinking about. I think about stocks. I want to buy this stock. I want to sell that stock. You look at this all day. The hedge is a portfolio issue. You want to put it as much as you can into a set it and forget it mode. And if I was trading vol all day and I was paying attention to these options, probably wouldn't make that much of a difference. But that's the reason. The downside of it is that SPX options and NDX options are a much bigger contract. One SPX option is the equivalent of 10 SPY options. So notionally, it's a little bit harder to use because every single contract has a notional value, the amount of the index that it represents, of more than $500,000. NDX options are actually bigger still, so relative to Qs. And because of that, that may or may not work for you. So I apologize for that long sidebar, but yes, the short version is using SPX. I always maintain some longer dated hedge of some size and try to, adjust my deltas accordingly. So I hope that helps. Really apologize. I just went off on that for a long time. I'm so bad about that. I apologize. Okay. Let's see. It's a little bit clunky for me to scroll around on this through the chat. Let me see if I can help you out. Okay, so CrowdStrike 30 deltas. Is there another explanation? Let me see here. CP9, by the way, said with respect to Tesla, I'm a shareholder. I'm upset by the judge's decision. Your logic is right, and I'm in agreement. Okay, well, I'm glad somebody agrees with me. I think it's an important issue. We hear of jury nullification. This could be, it's very different context, very different kind of a thing. But you could have shareholder nullification of the Chancery Court decision, which was deeply flawed and unjust. Okay, so, and you can imagine, if you imagine this for just a second, getting back to that, sorry. Imagine if those options grants had just been for all of the employees. Would we be having this question? If they had said, we're going to give 12% of the company, they get to buy 12% of they reach into their pockets, buy 12% of the company at its current valuation. If between now and the next 10 years, they knock the cover off the ball and they did it, people would be writing books. They'd be making movies about it. They probably should do both anyway. But this wouldn't even be a question. It's just amazing. It's not about, oh, here, CP9, I voted already. Okay, great. Thank you for that. And why am I saying thank you? Elon should thank you. It doesn't give me any money. I just think it's the right thing to do. Can you also save on commissions if you... oh, okay, so actually this is a good question. Another important distinction between index options and ETF options. So if you're paying on a by contract basis, let's say that your commissions are 25 cents a contract, 50 cents a contract. I don't know what anybody's really paying these days. For my PA, I endorsing one outfit versus another. I happen to use Interactive Brokers. I don't know Tom Petterfee. I don't have any relationship with them. The reason, I'll tell you the reason why I happen to use it, and that is that it was not uncommon on some institutional desks to use Interactive Brokers platform as a backup to our own. So we were self-clearing. At Cantor, we had our own systems. We also used third-party systems for execution, third-party brokers to execute business on our behalf, but we cleared our own business. Interactive Brokers was self-clearing, but we used them as a backup. So if our pipes to the exchanges, if our own routing mechanisms and the other third-party trading algorithms we use broke, Interactive was just kind of our go-to as a backup. And I just became familiar with the platform because of that. I didn't cross shop it. I'm sure there are great deals out there, and I encourage everybody to do your own thing. But that was the reason. So when you trade SPY options, you have to trade 10 times as many as you do SPX in order to trade the same notional value. So if you're paying the same amount per contract, then in theory, you will save money trading SPX versus SPY, even if you don't care about the fact that they're European or cash settled. That's a potential benefit to trading the index. The flip side of that, though, is that the index options have a royalty. SPX is a proprietary product of this, what's everybody commonly calls the CBOE now, formerly the Chicago Board Options Exchange. And SPY options don't have that. Now, the royalty is not huge. I actually don't remember offhand what it is. Maybe that has changed. I believe it was 40 cents a contract. So 40 cents a contract for an SPX contract is the equivalent of 4 cents a contract for SPY, just doing that simple math. Does that matter? It's not a huge thing. Some charge you more to execute the index options. And they will do that because it is a bigger product, because it's a proprietary product, because they can. So again, check that. Your mileage may vary, but that's a very good point. It is entirely possible that SPX, NDX, and so on, even though you are paying a royalty. So in the NDX, it's obviously a NASDAQ product. Even though you're paying royalties for these things, it is indeed possible that they are less expensive in terms of transactions. But these days, transactions, believe it or not, as a prop trader working for a firm with 50 traders back in the late 90s, we used to pay Ready, which was that was the equity trading platform that a lot of people who were market makers at the time used, that got acquired. It was created by Spear, Leeds, and Kellogg and acquired by Goldman Sachs. We were paying over a penny a share, if you can believe that, to execute equity business, which even retail would never do today, I don't think. But it's keep an eye on your commissions. It certainly adds up, but it's not. These days with prices, it's not the end of the world. Let's see here. What else we got? I think, how long have I been talking? Oh, it's been, oh wow, it's been an hour or so. Debbie Dantes says, "Hi, Mike. You're in my area. Welcome." Oh, Debbie, does that mean you're in New Hampshire, or does that mean that you specialize in the type of law that the Delaware Court of Chancery was dealing with? I don't actually know, but if it's New Hampshire, I actually grew up a good portion of my time in the very house where I currently sit, it should be said. So Sunday being Father's Day and all the rest, I'm going to be seeing my father and my brother and everybody else. Happy Father's Day, everybody, because I'm not going to be doing another live stream. But I will point out that after this, I'm going to be going down to Cape Cod, and I will be there for a couple of weeks, and I will do more of these live streams, and I will hopefully, if we can figure out how to piece it all together, have more of the tools that I usually have. So the next one will be a little bit more conventional. I just wanted to talk before the Tesla shareholder meeting. With that, it has been, for those of you who are patient enough to stick around, which I always appreciate, I've chewed up an hour of your time, and thank you for hearing me out. And I now need to figure out how I turn this off. Do I just hit, I don't know, because I'm just going to say some button over here. Well, I'm going to say this. Thank you all for watching. Somewhere, somehow, this thing is going to turn off. And it's going to be fairly abrupt, but I'll figure this out. There's a lot of buttons over here. I don't know which one I'm supposed to press. Thank you very much for watching, and I'll see you on Monday, 4:15 Eastern.